Before we begin today's analysis, I encourage you to subscribe to our channel for thoughtful, research-based financial education. We focus on disciplined investing principles and market understanding rather than speculation. Subscribe button. Red. Today, we examine a significant development in precious metals markets. Major financial institutions are adjusting their silver positions, and these moves deserve careful analysis. This isn't about predicting dramatic price movements. It's about understanding how institutional strategies can inform our own investment approach. Large banks and investment firms hold substantial precious metals positions for various reasons. Some serve client demands, others hedge currency exposure. Still others position for long-term monetary shifts. When institutions like JPMorgan adjust their precious metal strategy, it reflects deeper market currents. These aren't random moves. They're calculated decisions based on extensive research and risk assessment. Understanding their rationale can improve our own decision-making framework. Several factors are converging in precious metals markets right now. Central bank policies remain accommodative globally. Industrial demand for silver continues growing, particularly in renewable energy sectors. Supply constraints have emerged in key mining regions. Meanwhile, investor sentiment toward hard assets is shifting as inflation concerns persist. These aren't temporary disruptions. They represent structural changes in how markets value store value assets. Silver markets have experienced significant volatility throughout history. The Hunt brothers' attempted corner in 1980 sent prices soaring before collapsing. More recently, the 2011 commodity supercycle drove silver to near record highs. Each cycle taught important lessons about market dynamics and investor behavior. Institutional memory of these events influences current positioning decisions. Smart institutions don't chase momentum. They position for structural shifts while managing downside risk. Unlike gold, silver serves critical industrial functions. Solar panel production consumes significant quantities. Electric vehicle components require silver for conductivity. Medical applications continue expanding. This industrial demand creates a supply-demand dynamic different from pure monetary metals. When industrial growth accelerates, it can strain available silver supplies. Institutions recognize this dual nature and position accordingly. Central bank policies directly impact precious metals demand. When real interest rates remain low or negative, holding non-yielding assets becomes more attractive. Current monetary conditions favor hard asset allocation in diversified portfolios. Institutions understand this relationship and adjust their holdings based on policy expectations. This isn't market timing. It's strategic asset allocation based on macroeconomic analysis. If you currently hold silver positions, avoid emotional decision-making based on short-term price movements. Institutional strategies unfold over months or years, not days or weeks. Review your position sizing. Precious metals should represent a measured allocation within a diversified portfolio, not a speculative bet. Consider your storage and liquidity needs. Physical silver requires secure storage and may have higher transaction costs than paper alternatives. Don't increase positions based on excitement or fear. Maintain disciplined rebalancing practices regardless of market sentiment. Those considering silver exposure should start with education before allocation. Understand the difference between investment vehicles. Physical metal, ETFs, mining stocks, and futures each carry distinct risk profiles. Begin with small positions if you're new to precious metals investing. Test your emotional response to volatility before committing significant capital. Consider dollar cost averaging rather than lump sum purchases. This approach can help manage entry point risk in volatile markets. Develop clear criteria for position sizing within your overall portfolio structure. The most dangerous error is treating precious metals as a guaranteed wealth strategy. Markets don't provide guarantees, and volatility can be extreme. Avoid over-leveraging precious metals positions. Margin trading and excessive debt can amplify losses during market downturns. Don't chase momentum without understanding fundamental drivers. Price spikes often reverse quickly in precious metals markets. Resist the urge to concentrate your entire portfolio in any single asset class, including precious metals. Never invest money you cannot afford to lose, especially in volatile assets like silver. Professional institutions employ sophisticated risk management systems. Individual investors need simpler but equally disciplined approaches. Set clear stop-loss levels before entering positions. Determine your maximum acceptable loss in advance. Diversify across asset classes and geographic regions. Don't let precious metals dominate your portfolio allocation. Regularly review and rebalance your holdings based on predetermined criteria, not market emotions. Maintain adequate emergency liquidity in traditional savings before speculating in alternative assets. Institutional silver strategies reflect broader concerns about monetary stability and inflation protection. These aren't short-term trades, but long-term positioning decisions. The global economy faces significant challenges. Debt levels, currency debasement risks, and geopolitical tensions all influence institutional thinking. Smart money doesn't panic. It It prepares methodically for various potential scenarios. The most successful investors maintain emotional equilibrium during market turbulence. This applies especially to volatile assets like precious metals. Fear and greed drive most investment mistakes. Institutional success comes from systematic processes that override emotional impulses. Develop your own systematic approach to investment decisions. Base choices on research and predetermined criteria, not daily market movements. Institutional strategies typically span multiple economic cycles. They position for structural changes rather than quarterly results. Individual investors benefit from adopting similar long-term thinking. Short-term volatility becomes less important when you're positioning for decade-long trends. This doesn't mean ignoring risk management. It means focusing on sustainable strategies rather than quick profits. Start with education before investment. Understand precious metals markets thoroughly before committing capital. Consider seeking professional guidance for significant allocations. Fee-only financial advisors can provide objective analysis without sales pressure. Use reputable dealers and storage solutions if choosing physical metals. Research costs, insurance, and liquidity options carefully. Institutional silver strategies offer valuable insights into professional investment thinking. They emphasize preparation, discipline, and long-term perspective over speculation. The key isn't to copy institutional trades, but to learn from their analytical framework. They focus on structural trends, manage risks systematically, and maintain emotional discipline. Your investment success depends on developing similar discipline within your own financial circumstances. No single asset class provides guaranteed returns, but thoughtful preparation can improve your odds of long-term success. Remember that markets reward patience and punish impatience. Build your investment approach on solid foundations of education, diversification, and risk management. The institutions making headlines today succeeded through disciplined execution of well-researched strategies. You can apply these same principles to your own investment journey. Stay informed, stay disciplined, and always remember that sustainable wealth building is a marathon, not a sprint.